Okay, let's dive right into this explainer. We're going to explore this fascinating gap between what you think your investments are making and what you're actually taking home. You know that feeling when you look at your savings account statement, you see that interest hit at the end of the month and you feel that little spark of accomplishment? Well, today, we're unpacking the invisible financial forces that might actually be turning that spark of wealth into a bit of an illusion. It's really the ultimate financial question, isn't it? Are your investments actually growing? I mean, we all work incredibly hard for our money. And when we park it into seemingly safe savings or investment accounts, we absolutely expect it to work hard for us in return. But here's the catch. That number you see smiling back at you on your screen, it doesn't always tell the whole story of your wealth. In fact, it rarely ever does. So let's set the stage here. Say you lock in an attractive, typical advertised return of 5% on a bond, or maybe a high-yield savings account. That sounds fantastic, right? You're beating the standard rates, making a solid return, and on paper, you're going to be 5% richer at the end of the year. It's a genuinely great feeling to secure a rate like that. But the reality is often quite different. Depending on the broader economic climate, your wealth might have only grown by 2%. Yep, less than half of what was advertised. So where did the rest of it go? How can a 5% gain just magically shrink? Well, this tension between expectation and reality is exactly what we need to unpack today. Section 1. Nominal versus real rates. All right, first up is the nominal interest rate. Think of this as the shiny top-line number advertised on investment products, bank windows, or loan documents. It's simply the stated interest rate before literally anything else is taken into account. It's the absolute raw percentage of profit your investment generates on paper. Pure and simple. Now, contrast that with the real interest rate. This is where things get completely grounded in reality. The real interest rate is your nominal rate, but adjusted to remove the effects of inflation. So this number reflects your true purchasing power. It's the actual tangible growth of your money after the invisible forces of the economy take their inevitable cut. It's what your money can actually buy you out there in the real world. When we contrast the two, that advertised nominal rate is basically an illusion. It's the best-case scenario that the investment product really wants you to see. The adjusted real rate, on the other hand, is your reality. Because of this dynamic, nominal rates are almost always higher, except during those super rare economic periods when deflation takes hold. Honestly, if you're only looking at the nominal side of the equation, you're pretty much navigating your financial life completely blindfolded. The crucial point here is understanding the invisible thief that creates this huge gap, and that's inflation. Simply put, it's the decline in purchasing power of a given currency over time. When the general level of prices rises, a single unit of your currency effectively buys less of the assets or goods you're trying to acquire. It just doesn't stretch as far. Section 2. Calculating your real return. So how do we figure this out? To calculate your real return, you just follow a pretty straightforward step-by-step path. Step 1, you identify your nominal rate, that advertised number. Step 2, you subtract the current inflation rate. But don't stop there. Step 3 is absolutely critical. You have to account for taxes and fees. Things like investment management fees and capital gains taxes will drag down that true growth even further. To get a perfectly accurate picture of your real rate of return, all of these real-world deductions have to be factored into your math. Let's ground this macroeconomic theory into a deeply personal, everyday scenario. Imagine you've managed to save exactly $10,000, and your goal is to buy a specific car. But hey, you're financially savvy, so you decide to invest that money for a year before actually buying it, hoping to generate a nice little cash cushion left over after the purchase. Okay, let's see how this plays out over 12 months. Your $10,000 sits in a savings account, earning a solid 5% nominal interest. Great. That leaves you with $10,500. But now factor in the inflation side of things, which was running at 3%. That means the general price of goods, including that car you want, went up. So the car that cost $10,000 last year now costs $10,300. And this brilliantly illustrates the whole point. After you buy the car for $10,300 using your new $10,500 savings, the remainder in your pocket is just $200. Even though your account grew by $500 on paper, your actual increase in purchasing power is only $200. That represents a mere 2% real rate of return on your initial investment. That $200 is the only true wealth you actually gained from waiting a whole year. Section 3. The 1970s warning tale.
The late 70s and early 80s were this dramatic era of economic history, and they honestly serve as the perfect representation of this trap. If you had a savings account back then, double-digit nominal interest rates were totally commonplace. Just imagine getting 10 or 12% on a standard bank account. But here's the kicker. In 1979, prices increased by a staggering 11.25%, and in 1980, they surged even higher, increasing by 13.55%.
As our source material perfectly summarizes, the profits from double-digit interest rates were eaten up by the effects of double-digit inflation. This highlights exactly how high nominal gains can drastically overstate your actual returns. People thought they were getting rich on interest, but their money was actually losing value in the real world because the cost of living was rising so much faster than their bank balances. Their real rate of return was literally negative.
Now, what makes calculating all of this a unique challenge is that inflation is what economists call a trailing indicator. This just means it's a metric based on data reflecting past events. You can't know precisely what inflation will be over the next year. You only know what it was over the past year. Because it's trailing, you only truly know your precise real rate of return after the fact, once the period has already ended. It requires looking backward to actually understand your true forward momentum. Section 4, the bottom line. All right, here are the core takeaways we need to remember. First, real rates adjust for inflation, showing your true purchasing power. And frankly, this is the only metric that actually matters for your lifestyle. Second, never forget that nominal rates are just those shiny numbers investment products advertised to get your attention. Third, taxes and fees will further reduce those real returns. So always factor them in. And finally, understanding this distinction is just absolutely essential. You've got to regularly assess your investments based on real rates to ensure you're making informed decisions and keeping a realistic view of your wealth.
So, I want to leave you with this final thought. If nominal rates are just an illusion, what is the real rate of return on your portfolio right now? Seriously, take a moment today to look at your own investments, check the current inflation rate, and do the math. Are you actually gaining ground, or are you just running in place? Thank you so much for joining me for this explainer. Keep questioning those numbers, protect your purchasing power, and I'll catch you next time.